Okay, welcome back. And it's time now to turn our attention full tilt to the quick commerce space, a space that has continued to see a lot of momentum. And as per a Kearney India report, the market is slated to triple come 2027. To understand the key triggers, what's influencing purchasing behavior, Siddharth Jain, managing partner and country head at Kearney India, is now with us on the show. Thank you very much, Siddharth, for joining us. You know, quick commerce is no longer just a convenience, right? Like, my consumer purchasing habits have changed. Earlier, it would be planned, there was and now there is this spontaneous shopping, this impulse shopping, plus, of course, what you need, but it's changed now for the good. And according to you, this is a phenomenon which is here to stay, and consequently, the market size of consumer retail is expanding. So take us through the thesis and some big numbers that you've thrown up in the report for us.
Yes, absolutely. Very well put. Firmly believe that this is here to stay. It's changing the way consumers shop, the way they think about brands, the way they think about categories. And we are seeing that play across categories now, starting from grocery, which was the leader in this. What our research shows, both from demand side trigger, supply side trigger, we see this tripling in the next couple of years, touching roughly 2 lakh crores worth of GMV, grocery plus non-grocery combined. A large part of it is also through geographic expansions into smaller towns. It started with a metro phenomena, but we see it play out in the top 100 cities for sure, if not beyond. Category-wise, what's most interesting so far has been that staples, which is obviously the largest category, has also seen a very good adoption on this channel, which is counter to the thesis of this is only an urgent need or impulse buy channel, right? Staples is something that households would typically be most planned around. But even there, we see a fairly significant shift, right? So I think growth cross-category, cross-market, 3x size and becoming, for many categories, as large as the traditional e-commerce channel is what we see.
So 2 lakh crore is grocery plus non-grocery by 2020. Of that, grocery would still be 1.5, 1.7.
Yes,
right?
roughly 80%
would still be
just
grocery.
The sheer sizes.
And just to put this number into context, what would the e-commerce and the general trade size look like 3 years down?
See, e-commerce, of course, is very large because of electronics and fashion, right? So if I take out electronics and fashion and just focus on grocery, today it's already 60-40, 60% quick com, 40% e-com. By 27, I think it would probably be 80-20 as per our estimate, or if not even more. So most of grocery purchase would move to this channel online. General trade is still very large, right? So I think it will still be a 90% general trade number at a national level, right? But if you narrow down to large cities, it starts becoming more relevant because in metros, the way of buying is moving away to this channel at a much higher scale.
Siddharth, thank you for joining in firstly. And, since you mentioned it's here to stay, right? Because would it be fair to say that quick commerce has now become a one-stop shop for everything that you need? Because not just groceries, fashion, electronics, and some platforms are even started to offer over-the-counter medicines now to be delivered in just 10 minutes, so that the need to go to a medical store, put in a prescription, and then get those medicines has almost gone out of the window. So would it be fair to say that it's now become a one-stop shop for almost everything that a consumer needs, or you're still getting there, it'll take a while, and then maybe in a year or two, we'd get there?
I would balance that a bit. I don't think it is a one-stop shop or can become a one-stop shop because there is a physical space constraint that it still deals with, right? The whole model is designed on dark stores in dense urban neighborhoods where getting to a larger space is theoretically impossible beyond a point. And hence the assortment that you carry is limited, right? You would see that there are 10,000 to 12,000 SKUs that they are able to sell today. Whereas if you look at online channels like Amazon or Flipkart, which are true long tail assortment, they are in some way the real one-stop shop for a lot of categories like general merchandise or fashion. But categories which are more branded and lesser assortment, for sure, this will become a very primary channel for consumers.
So one of the reasons why perhaps it's not made inroads into electronics, like it has in grocery where we've seen very high adoption, is also the discounting. Right?
Yes.
Even now, the discounts on your traditional e-commerce platforms are a lot higher than what you get on your quick commerce, which is when I'm going ahead and making a large purchase, an electronics purchase, I will still gravitate towards an e-commerce, because that's not a spontaneous buy. It's a thought through, and you want to maybe even go out and check out the size of the TV or refrigerator. So talk to us about the discounts, right? Because, will the model continue to see lower discounts vis-a-vis e-commerce, general trade? Because you're also adding in delivery costs, and then it's not relatively cheap then.
Yeah, absolutely. And the discounts assessment was a big part of the report, and there's some interesting findings there. I'll come to electronics later, but in the core grocery category, the discounts on this channel is 60 to 70% of discounts on traditional hypermarket formats of modern trade or e-commerce formats. And we have still seen this growth, which would mean that consumers are paying that premium for the convenience that they are getting of getting stuff delivered at home. What we are also seeing is that newer models are emerging. So players in this space would probably segment and start offering higher discounts on bigger baskets, right?
So super savers.
Savers, for example, yes, right? So they will try and match pricing for higher bundles when consumers are willing, but for the smaller baskets, it will be a premium that consumers would pay. On electronics, though, you are right, it is not possible to have too much of a differential in pricing. But interestingly, most of the discounts on that channel is funded by the brands, and the brands themselves would want to have parity in pricing. So I think prices on electronics will converge here, and you would probably get an iPhone at a very similar price at a faster speed. And if that happens, then adoption should go up on electronics.
Even for electronics then. So what are your thoughts on profitability? Because you want to scale. Investors are pushing for profitability, and plus there is going to be increased competition for wallet share with newer players, not stronger players, but newer players with deep pockets coming in. So how do quick commerce companies get profitable?
Yeah, I think that's a billion-dollar question for many investors. But I think fundamentally, if I look at the business model, in the long term, I am fairly convinced that it can be a profitable model. If you look at the unit economics and the underlying drivers, they are fairly in the right direction. Of course, Blinkit was reporting positive numbers, and it still is UC positive, and most dark stores are profitable. I think, but the full profitability and the cash cycle with intense competition, if I draw parallels from other sectors we have seen in past, would definitely push out profitability. And I don't see that in a very hurry, in a short time, you can turn fully profitable. But over a longer period of time, if you're taking a long-term view, I don't see any reason why this should not be an economically profitable model.
Now, how long is a long term is always the question, right, Siddharth? Because you always say long term. For some, a long term would be 3, some would be 5. Would it be a fair estimate, say maybe 3 to 5 years before they turn fully profitable, or is a slightly longer run ahead for them?
Yeah, I think 3 years is a good estimate. But see, one big difference in this channel and e-commerce is the fact that the key players are listed companies with public market pressures, right? So I think there will be more sanity in the way players, behave as far as discounting is concerned or customer acquisition is concerned. So that would mean that it should be a shorter time. Whereas if you look at e-commerce, players have been there for more than decades now in India and still burning some cash, right? So when you don't have that pressure, it's probably easier to sustain for longer because the market is so large that you can always aspire to be bigger and bigger before focusing on profitability. But if I have to put a time, I would say, 2 to 3 years, you should definitely see winners emerge and a more profitable model.
Quick commerce has also caused a huge employment boom. And your report talks about, you've done some study on it. Take us through the nuances of this.
That was very interesting for us, right? Because there's always a question on what is it doing to the economy, what is it doing to channel disruption, etc. So 2 parts to it, right? The way we looked at it is first, the demand that's coming to this channel, is it all replacing other channel demand, or some new demand is also getting generated? And second, for that demand, what employment is needed? And we did a full value chain assessment to estimate that. Interestingly, for every crore of GMV that you earn on the channel, our estimate says that for monthly GMV of 1 CR, 61 to 62 people are employed on this channel. That's almost similar to an average Kirana channel, right? So from an employment intensity, because of the last mile delivery model, it's fairly intense and generates that employment. On the other hand, modern trade and the traditional e-commerce are significantly lower employment, almost half of this, if I may, right? So to that extent, it's more labor intensive. And from a demand substitution, we do see that 6 to 8% of the demand is actually completely incremental demand that otherwise would not have happened had the channel not existed, because of habit changes and last minute impulse purchases that consumers are making. Of course, large part of it is still a channel substitution, because I will not consume more rice and atta just because I'm buying it faster.
But Siddharth, a trend that has emerged over the last few years is premiumization, and that's evident across categories, be it real estate or be it automobiles or whichever be it. But even in gifting,
yes,
personal care, there's a lot of premiumization that is happening. Have you witnessed a trend where all of these personal care / gifting products, especially in the premium category, are launching first on quick commerce platforms before they become available in, say, larger stores or in exclusive brand outlets and so on and so forth? Have you witnessed such a trend?
Absolutely. It's not across all categories yet, but you picked up right categories. Gifting as a category, personal care, even munchies and sweet tooth items. We do see both from supply side, traditional players are launching specific products for this channel, testing newer variants on this channel and getting customer feedback. New brands are emerging, right? We see categories, for example, it's amazing that categories like bakery, the largest player is a completely new age player and not a traditional bakery household name, right? And same we are seeing in other categories like dry fruits, for example, right? So new players are emerging, traditional players are launching new products, and consumers are experimenting. So it is driving premiumization, not across all categories, but and the report highlights categories like sweet tooth and munchie or personal care, where there is more premiumization that we see happening and playing out. And more of that will happen across categories as players experiment and launch new products here.
I have just two quick questions. One of them, of course, is how spending by brands has changed, right? Earlier, you were buying by the e-commerce. You were trying to get the consumer on the e-commerce platform. Now you've got this thrown in. So how has that changed?
Yeah, I mean, we looked at investment that brands are making in just channel spends, right? In the form of advertising on these channels or special incentives and offers. It is at par to modern trade and e-commerce now, and more than the GT channel. So brands are looking at this as a strategic channel and investing more money on this than the traditional channel, and funding a lot of the offers and consumer promos that you see. And we see that trend play out because for everyone, this is an important strategic channel for future.
Okay. One quick question. We spoke about profitability, and then you were saying that how e-commerce companies, because they don't have to manage the investors, right? They're still burning cash. Now, when I compare quick commerce to an e-commerce, as you said, quick commerce companies need to hire, it's more labor intensive compared to e-commerce. Plus, you don't have a centralized warehouse that an e-commerce company has. You have so many dark stores all over mushrooming to meet the demand. So it just feels inherently they've got far more costs to contend with. So how are they going to be making that money?
No, that's not true. The costs are sitting at different places, right? In modern trade, for example, the cost is rent, right? The real estate cost is far higher.
No, I'm saying compared to an e-commerce, for instance.
E-commerce has a lot of cost in supply chain because they have these mega warehouses and a lot of sortation because they carry 100x more assortment and the inventory costs are far higher. So one thing which we don't realize is this channel is the most efficient in terms of inventory turns because the lack of space means that you keep very little stock, and hence, so there are some efficiency drivers in the channel as well.
Supply chain is one, and inventory management. Any other?
Yes. And, the customer acquisition cost is much lower here because the stickiness is far higher, right? Once a consumer comes onto this platform, they are buying 5 times a month, 10 times a month. So the repeat costs are much lesser here.
Indeed, Siddharth, pleasure having you here. Thank you so much for sparing time and joining us on this very interesting conversation on the insights that you had.
Thank you.
Thank you for coming down.
Take a short break. More news and updates continue on the other side. Stay tuned.